Hey, welcome to the Mortgage Minute. Today is October 24th, and lots of stuff to go through today. But at the same time, a lot of the same stuff. Global crisis, rates remaining unchanged, but threats of increasing rates. What's it all mean to us? The Bank of Canada, of course, Mark Carney came out yesterday and said that although he sees imminent changes. It was interesting. Imminent changes is what he said. Overtime rates are more likely to go up than not, but for now they're not going to do anything. Let's take a look at the backdrop of all this and take a look at what we're seeing in terms of the last few weeks in headlines. The big, of course, area that is just really coming out here, two things. First of all, IMF warns of global slowdown. Investors brace for more change. I think a lot of people, and for those of you who are real estate investors, look for people who are looking to invest money are going to have challenges because they're not getting a very good return on their capital. Therefore, they're going to be maybe looking at some real estate, maybe investing in mortgages. Global outlook turns darker. You can't be faulted if you start feeling negative after reading all these headlines. This one was interesting. It made a comment about Canada. It said, given its strong economic and financial ties to the U.S. economy, Canada is equally exposed to the risks facing its trading part. In addition, an important domestic vulnerability in Canada relates to the housing market. So, look at the housing market. Canadian debts soar. Debt higher than thought. I think they said 163% of Canadian income, its debt-to-income ratio is now 163%. Considered to be one of the highest ever. Record borrowing tops pre-crash peaks in the U.S. and Britain. And as a result, it says only higher interest rates will slow Canada's swelling debt crisis. What I find interesting about this is a lot of talk about the high debt, and then they talk about the housing market, and they say they should raise rates. Well, my question is, if we're worried about the debt that Canadians are taking on, and yes, they're taking it on in their housing, but why are we not addressing credit cards? In my opinion, when people have 19% interest rate on credit cards, that's a far bigger issue than paying off your mortgage at 3% or borrowing on a line of credit at 3.5% so that you can consolidate high interest credit card debt that you're paying 19% on. I think the government should spend more time focusing on the credit card issues rather than the housing issues, albeit your limits on a credit card are far lower than the limit on borrowing equity in your home. So it's just interesting. I don't know if you got any feedback or thoughts on that. Feel free to share. But here it is. Canada's credit bubble, a dilemma for the central bank. On one hand, Mark Carney, again, as always and as in the past, is forced to keep rates down because of global economic pressures. But he feels that we're using our house as an ATM machine, and when there's a sharp increase in rates, or again, when, not if, how will people be impacted? We did some math today in our office and looking at consumers who are taking 5-year rates today. If they renew into interest rate environments that are 2 or maybe 3% higher 5 years from now, they may be shocked with a $200, $300, $400 a month increase in mortgage payments, some depending on how much your mortgage is. Again, another reason, if that concerns you, to look at the 10-year rate today, which is still less than 4%. Well worth looking at. And again, just going to wrap this up with the Bank of Canada decides to hold their rates yesterday steady. And this is the 25th time in a row that they have 25th consecutive month on Tuesday that they decide to keep it at the same rate with no change. That's the longest pause since the 1950s. So it gives you an indication of how much Mark Carney's hands are tied. But again, the most recent hold on rates, he indicated a lot of talk about the housing debt and the overall debt that Canadians are getting into. So, some of that's more of the same, but there's a bigger picture here I think we got to look at is if you're concerned about rising rates, lock in for the long term. And if you have any questions about this, I want to invite you to send, if there's anything you want me to talk about, questions about this or other topics, I'm going to encourage you to send me an email and we will address it in the Mortgage Minute in the upcoming weeks. We'll take the Mortgage Minute take that time to address questions from you, our listening audience. So again, that's the Mortgage Minute for October 24th, and you can go to peterkinch.com to learn more. Thanks.